What is going on, guys? Hope you guys had a great trading week. What a week it's been. All four major industries or indices closed on a green note. S&P 500 touched, all-time highs. Nasdaq rallied, although Nasdaq didn't touch all-time highs. We've seen pretty much a big pullback towards the upside on Nasdaq. Russell, is towards the upside of the channel that it's been for the last few months, and the transportation actually is at all-time highs. We broke, last week or this week, and the transportation is pretty much a sign of, pretty good indicator of the economy. So what I wanted to discuss today was the S&P 500. So what happened last week, in the past couple of weeks actually, and what my predictions are on it on the future. Right. So we've been pretty much, rallying up this whole week. To begin with, we started off with low volume, and then the volume did, actually decrease throughout the week until Friday, where I guess you could say we had a red day. Not really. It was pretty much break even, but it was the first technically red day in 7 days. And as you guys could see, the volume was pretty high. So when the volume is this low and there's really big rallies, that's usually a short squeeze. So people are covering their shorts, and they're not actively buying the stock, but that's still, or buying in this case, the ETF or the futures or whatever, and they're not necessarily buying it, but could be most likely a short squeeze, and that does push up the prices. So pretty much what happened, ever since the pandemic, we've been touching the 50-day, never broke consecutive candlesticks below the 50-day until last month. We actually broke it, and then immediately we touched the 100-day moving average, which last time we touched that was in November of 2020. So that just shows the amount of damage that was done to the S&P 500. Pulled on back to the 50, went back to the 100, and then we consolidated a little bit, and then now we're here. This week we rallied. We're at all-time highs again. Right. So pretty much what I was going to discuss is the gap fills. So a few weeks ago, I made a video on how this gap right here was left open, and we were consolidating here, and gaps on the S&P 500, they tend to fill within 2 to 3 weeks, maximum 3 weeks. Maybe if it's a small gap, it could take longer. But whenever the gaps fill, that's like, a relief for the market, especially on the S&P 500. Not much on, the Nasdaq and the Dow, maybe a little bit on the Russell, but the S&P 500 is the most, followed index by the gap fill traders, I guess, if you want to call it that. So, why am I mentioning the gap from 2 weeks ago? Because as you guys could see, the crazy rally that we've had, does come with some gap ups. Now, there was a gap right here. We filled on Monday. We filled it, which on Mondays I usually never play the gap play, but we did fill it in this instance. So, we did gap up here. This was a pretty big gap. Right here, we almost filled the gap, but didn't. Right here, is an open gap. So, pretty much what my theory is behind this is that, once we are here and, we're at all-time highs, consolidating a little bit, more likely than not, these gaps will eventually fill. Might not happen, next week. Maybe will happen in 2 weeks or 3 weeks. You never know. You can never predict the market, but this one especially is a pretty big gap, and the markets will pull back down to fill this gap. So at this point, pretty much all my long positions are covered for anything tech related, S&P 500 related, big market cap stocks. All my long positions are covered. And I'm potentially looking to short the S&P 500. So as I said, we're at all-time highs. That's one reason. There were 3 gaps right here that we didn't fill. The gaps will most likely fill within the next 2 or 3 weeks, based on history. My third reasoning is the LRC, the linear regression channel. So what the LRC is, we get the mean of the last 38 days. That's the default setting on Thinkorswim. So a lot of traders use that, and pretty much we went outside the second standard deviation. These red lines are the second standard deviation. The purples are the first standard deviation, and price needs to stay, or it will stay, in this 98% of the time, according to statistics, right? So we also have this that touched the outside of the second standard deviation, and it's very unlikely that it will break this and break all-time highs as well. So we also have that. Last week I did end up taking a losing trade on the S&P 500. So as we touch the top of the expected move on Wednesday morning, I did a vertical credit. This was pretty much my only confirmation. I did get very impatient. I took the trade to the downside, sold some call verticals, and as you guys could see, it wasn't a very successful trade. I was down around 40%. And I closed the position, and it was a losing trade. But it is what it is. Trading shouldn't be all wins. It does include losses. But that's the trade I take. I took. I probably should have not taken it. I should have waited for some sort of reversal or consolidation. Although we did see a slowdown on the decrease of volume, we didn't see a consolidation. So pretty much what my plan is for the next for the upcoming week is I'm going to be watching SPY very closely, like I do every single day. I'm going to wait. This is the hourly chart on S&P 500 futures, and as you guys could see, looking on the Ichimoku cloud, the Ichimoku was relatively thick, as the cloud was relatively thick as we were rallying. We didn't touch the cloud ever since the rally started, and then Friday was the first day that we touched the cloud. So what my entry point will be for this short on S&P 500 is once we do break the Ichimoku. I'm going to use the 9 exponential and 21 exponential moving average crossover is what I usually use with the stochastics. And, I'll be entering my position there. What I will be using to trade is I'm probably going to be doing some directional puts. Or if I do end up doing a spread, I'm probably going to end up doing something like a vertical spread that's on the debit side, right? Why on the debit side? Why not on the credit side? And that was another mistake I made on the last trade. I should have took it on the debit side, although it really doesn't matter. And the reason is the VIX is really low, and we're pretty much at a support, as you guys could see right here. However, everything is still looking negative for VIX, but as S&P 500 pulls back down, VIX is gonna start pulling back up. VIX and the S&P almost all the time correlate negatively. So if we do end up seeing, the S&P come down, which is my prediction for the next few weeks, if we do get, that confirmation, if we do break all-time highs, so be it. I'm not going to take the trade, obviously, but if we do get the confirmation to the downside, the VIX is going to start trickling up. And once the VIX trickles up, we are going to see the implied volatility of the options increase. So when the implied volatility of the options increases, the price of the options, regardless of the price of the underlying, increases in volatility. So that's why you want to be on the debit side, because if you're on the credit side and the volatility increases, you're automatically losing unless the price is working with you, and obviously the time decay is working with you on the credit side. But that's if you do the debit in this scenario, in my opinion, you'll have a bigger edge over doing the credit spreads. But that is going to be it for today's video, guys. I'm going to go ahead and make a updated trade on, or an updated video on if I did take the trade, what my plays will be next week. Go ahead and comment down what kind of videos you guys want to see, and then I'll be looking forward to making some more of these videos in the near future, and I hope you guys enjoyed the video.